Segment is brought to you by Forever Remodeling, stress-free and high-quality remodeling. View their stunning transformations online at the number 4everremodeling.com.
Now, from the Signature Bank Studios, this is Chicago's Morning Answer with Dan Proft on AM 560. The Answer.
Top of the morning, Dan Proft here. Nothing can stop this bull market, not a quote-unquote government shutdown, not meltdowns in urban centers, nothing. Well, I don't know about nothing. Paul Tudor Jones, who is a billionaire hedge fund manager, believes that conditions are set for a surge in stock prices before the bull market tops out, and there's the painful correction. That's what he thinks. That's what he said on CNBC this morning. My guess is that I think all the ingredients are in place for some kind of blow-off. History rhymes a lot, so I would think some version of it's going to happen again. If anything, now is so much more potentially explosive than 1999, talking about the dot-com bubble bursting. And Paul Tudor Jones correctly predicted the 87 crash, which is what shot him to prognostication stardom. He says you have to get on and off the train pretty quick if you just think about bull markets. The greatest price appreciations always occurs the 12 months preceding the top. It's kind of doubles whatever the annual average is, and before then, if you don't play it, you're missing out on the juice. If you do play it, you have to be really happy, have really happy feet, because there will be a really, really bad end to it. And so he seems to be indicating we're getting to that point, but he's not getting off the train yet. He said he would own a combination of gold, cryptos, and NASDAQ tech stocks between now and the end of the year to take advantage of the rest of the rally before perhaps paring back and rebalancing. For perspective on that and just the market conditions generally, pleased to be joined by Jim Perry, founder, CIO of Perry International Capital Partners. James, thanks for joining us.
You're welcome, Dan. Thanks for having me.
So are you and Paul Tudor Jones in sync, or do you quibble with what he had to say?
We are in sync, which is what scares me. You know, I've been overweight the S&P 500 and the U.S. stock market for a year, right? And it's been a really good run for all of the right reasons. Top line revenues are stronger at the S&P level than they have been for quite some time. Bottom line profits never been better. You know, we're running at sort of 12% profitability. And if you look at the tech sector that's driving everything, revenue growth and profitability in that sector is running at kind of, almost 30%. So if you're in the right stocks and technology focused, you're having a pretty good year. And that kind of gets us back to, what moves markets, right? And I've always talked to you about, I like getting the dollar right first. The FX market gets it first because I'm a global investor. And then you get interest rates, and then you look at corporate profitability and then where the economy is going with respect to employment and housing. But, the dollar has been trading very steadily since April, and there's money coming into this country to the tune of, I think I saw the numbers last week, Dan. The S&P 500, or U.S. stocks generally, are worth about $65 trillion. And 20% of that is owned by foreigners. So you're looking at $12.5 trillion of foreign investment. So money's coming into this country, and interest rates are pretty stable too. The 10-year Treasury is still at 4.10, 4.11, 4.12. That's been going sideways for 6 months. That's a really good backdrop for the U.S. equity market, and it's delivering. And
but everything is going up in tandem. Gold is up. Bitcoin just hit a new market cap high, right, as well as equities. So, we've talked about this before. So what is the hedge on all this? If you believe inflation is still a fundamental problem, the hedge is real assets like real estate.
Right. Well, this is where things get a little bit scary and crazy because the big reason we're here is inflation, right? I mean, a year ago I talked about the 5 real pillars of this new administration's domestic policy, which is lower taxes, deregulation, reduced budget deficit, reduced trade deficit, and enhanced national security, which means a more peaceful world. The problem was, and I brought my allocation of stocks down by about an eighth from the highs when the government passed this big, beautiful bill and they didn't cut spending as much as they should have and could have. So I think that they're letting inflation run. I think the Fed, by moving last week, has kind of bowed to the administration a little bit. And I think that when you look at the Fed and the Treasury Department, they kind of work in tandem, which is why there's confusion with all this sort of independence and all that sort of stuff. But the bottom line is the government is opting for policy which will support and continue to drive the inflationary pressures that are in the system. And that is why gold and crypto and the stock market are doing well. It just doesn't go as far as we need it to explain why interest rates haven't gone up so much, So it's pretty complicated, but the Fed and the government is letting inflation run here, and that's going to give us cause for concern going into 2026.
I mean, sure. But there's always this talk about budget deficits, and and like when I listen to market analysts talk about budget deficits, it's sort of like listening to politicians talk about them. It's sort of the thing you're supposed to say, but nobody does it. Yeah, well, nobody seems actually concerned enough to do anything or to adjust their behavior. So I mean, how big a deal is it really? It's just something that they can blame then and point fingers at one another when there's ultimately a correction, it seems to me.
Yeah, that's a very good point. And then the reason the analysts don't talk about it much is because they know inflation is really good for the stock market, right? So they kind of don't care. Here's the thing. Since the bottom of the financial crisis, which was the mortgage crisis, sort of 2010, the S&P 500 has returned 16.5% per year for 15 years, right? This is an incredible run in the stock market. So everybody that owns the S&P 500 is doing great, right? So inflation has been very good for them, asset owners. If you look after inflation, the S&P is up 10%, right? After inflation. So the best hedge you can possibly have is the stock market, because what happens at the corporate level when everybody gets nervous about tariffs and increasing prices? Well, everybody that's in the S&P raises their prices, whether the tariffs are causing them or not, and says to them, well, we have to be careful about tariffs, and people are afraid about tariffs, so they pay the extra money. This is why profit margins at the S&P are rising really, really more aggressively than they have since the pandemic. So inflation is good for investors. The problem is if you don't own a house and you don't own the stock market, you're falling behind, and your disposable income and your cost of living adjustments can't keep up with things.
Well, and the weakening dollar, too, as a result, it reduces your purchasing power. But we had this a bit of a debate last week on the program with John Tammany about this, with him essentially saying that the president sets the value of the dollar at whatever level he wants. He just sort of does so rhetorically, which is a bit of a curious position. But I guess the larger point is the posture that a weak dollar helps American exports, and that is a net benefit to the economy. It's not something I subscribe to, but it's something that's advanced by at least some of those around Trump. And I wanted your perspective on the impact there.
He's not incorrect, but when it comes to the FX market, it really is about a lot of different economies doing a lot of different things, right? So what happened this weekend? Well, the yen has gotten hammered since the election of a new prime minister in Japan yesterday, right? First female prime minister in Japan's history, and the 5th prime minister in 5 years. And she is a nationalist, and she is for stronger immigration policies and a stronger border to protect Japan's cultural core, right? At the same time, we've had a resignation in France, right? The prime minister in France resigned. This is like the fifth guy that has had that job in 2 years, right? So you look at the numbers behind the governments in the European Union and Japan, and you will find that their debt to GDP ratios are 2 and 3 times worse than the United States, that their government spending numbers are 50% or 100% higher than the United States. And you kind of wonder, how could the dollar possibly go down against the two major currencies that it's traded against in the world, right? This is the yen and the euro. So the dollar is going up by default because the two major trading partners of this country have worse financial conditions than we do. And in fact, their policies and their political situation are much more precarious as well. So again, trade is one thing, and a cheaper dollar does help Boeing and Caterpillar Tractor and stuff like that. But, you know, the dollar, if it's going up, it's because the yen and the euro are going down. Same with our big adversary, the Chinese. The Chinese yuan, you know, they probably have to devalue that because they're spending more than everybody combined.
So I was having this discussion with a couple guys playing golf with this weekend who are pretty sophisticated financial professionals. And we're talking about AI. And the question sort of is everything that we're talking about that we've discussed for the last 10 minutes, does it all rise or fall with the sort of revolutionary impact of AI, how fast it comes and how wide it comes at what speed? Number one. And number two, a sort of secondary question. If it's going to come fast, and thus it's going to continue to carry the preponderance of the weight in the market, then it's going to have perhaps much more wide impact in terms of jobs disappearing too. And so does that put us on a path where it's going to require even more government spend? Because look, to stave off social unrest, if you have a lot of people displaced from their jobs across a lot of different sectors, you're going to have to move to something more, sort of have it informally now, but something more formal in the area or in the direction of universal basic income.
Right. There's a lot to chew on there.
Yeah.
Try to break it down a little bit here first. To your first point, the AI revolution is for real. The spending that is happening in the data center build out so that you can have more sophisticated information models is running at about 5% or 6% of GDP right now. Okay. So, and GDP is about $30 trillion. So, do the math. You're looking at about $1.5–2 trillion worth of spending toward GDP, toward AI now, right? And if you go out sort of 5 years from now, that spending is projected by one of the major megascalers. I've gotten an internal document from them, and it's a good one, and it's a household name. Everybody knows it. But they're projecting that the spending on AI by 2029 is going to be on the order of 25% of GDP, right? So you're talking about a technology sector that is, in fact, driving everything, right? The profit margins in the tech sector are running at about 30%, and the S&P in total is running about 12, right? So the point is that if you don't have the tech sector, your GDP numbers all of a sudden become rather mundane, right? So the AI spending and build out is huge, and I think the numbers involved are huge. They're going to keep getting bigger, and it is driving the economy. Now, what does that mean? Last week I wrote a weekly report saying the biggest question that I got is, when are the revenues coming from this great AI dream that we keep hearing about, right? And I would argue with you that they are already coming. And if you look at the revenues of the top 5 to 10 megascalers, most of their revenue increases, which are, by the way, 30% and 20% with profit margins at 75%, they're getting a tremendous amount of revenue from AI subscriptions. This is a subscription model like everybody's got on their phone, right? Look at your monthly phone bill. You'd be surprised how big it is. It's not $100, it's $600, right? Everybody buys these added on things and they hardly even notice it. But it's worth billions and billions of dollars of revenues to these companies. Secondly, most of middle America and the small businesses, which is where your job growth is coming from, and always comes from, they are utilizing AI to increase profitability by streamlining operations. That's happening across every single company in the country, whether that be legal firms, accounting firms, logistics firms, plumbing contractors, small restaurants, retail, mostly retail. Retail is using it tremendously. And is there going to be job losses? Of course there's going to be job losses. I mean, one of the reasons we're doing this report today on a Monday is because we didn't get any data on Friday from the government, right? But we do know what happened over the weekend was that, the government laid off over 100,000 people. Now, most of those employees, government employees, hadn't gone back to the office since pre-COVID. So they knew that they were going to lose their jobs anyway. And it's, I think there's something like 1.3 million government workers. So you're looking at 100,000 of them, probably another 200 going to go. Most of these people have other jobs already. So it kind of reminds me of the automobile industry, when the automobile actually started coming onto the streets of America and everybody was worried about the horse and buggy and what are all these guys doing who take care of all the horses and the horseshoes. Of course, guys who make horseshoes are going to lose their job, but that doesn't mean that the transportation industry is going to get smaller. It means it's going to get larger, and these guys are going to learn how to, change tires instead. So will there be an adjustment? Absolutely. Is it going to be overnight, and is it going to be easy, or is it going to be a little bit tricky? It's going to be hard. But the point is, the AI revolution and the artificial intelligence industry in this country is going to be a job creation machine, not a job destruction machine. It's just a matter of getting the right people in the right jobs at the right times for the right tasks are required to transition to an AI-driven economy.
James Perry is the founder and CIO of Perry International Capital Partners. Jim, thanks as always. Appreciate it.
Dan, thanks a lot. Have a good week.
You too. And Jim Perry joined us on the Turnkey.Pro answer line.
There's only one radio show in Chicago talking about today's biggest stories and telling you what they really mean. That show is this one, Chicago's Morning Answer on AM 560, The Answer.
The following advertisement includes a celebrity impersonation.
Nothing beats the comfort of a perfectly heated home.
And when it comes to heating your home, Air Right Heating and Cooling does it the best.